March 2020. The markets collapse in one of the fastest crashes in financial history. The S&P 500 drops 34% in 33 days. Millions of individual investors do the same thing at the same time. They panic, log into their accounts, and sell. They lock in their losses, and then they miss one of the sharpest recoveries in market history because they were sitting in cash, waiting to feel safe again. The investors who kept their money in automated portfolios, run by algorithms, not emotions, largely did not sell. Their robo-advisors had no fear. They held the position, and when the market recovered, they were fully invested for the entire ride back up. That is not a marketing story. That is real performance data. And it raises a question that is now more relevant than it has ever been. Should you actually let AI manage your own money? Welcome back to AI Capital Code. In the last 3 videos, we looked at how AI is reshaping the finance industry from the top down, how it is replacing parts of analyst roles, how agentic systems are running entire workflows at JP Morgan and MasterCard, and how the rules of financial careers are rewriting themselves in real time. Today we go the other direction. Today it is personal. It is your portfolio, your savings, your retirement. And the question is simple. Is AI good enough to trust with your money? And what happens when it is not? Let us start with the scale of what is already happening, because most people do not realize they are already partly there. Robo-advisors, AI-driven automated investment platforms, now manage over $1.8 trillion in assets in the United States alone. That is up from $1.4 trillion at the start of 2025. Vanguard Digital Advisor, the largest, holds $300 billion. Betterment manages $56 billion. Wealthfront manages $43 billion. These platforms are not niche. They are not a trend. $1.8 trillion is a meaningful slice of American personal wealth, already being managed by algorithms without a human advisor making the daily calls. And the platforms themselves have evolved dramatically. In 2026, robo-advisors are not just picking ETFs and rebalancing quarterly. Betterment's AI now handles simultaneous optimization across multiple goals: your retirement account, your house down payment, and a college fund, balanced dynamically against each other in real time. Wealthfront integrates with over 11,000 financial institutions to build a complete picture of your financial life automatically. Vanguard's AI now runs dynamic withdrawal strategies that adjust for market conditions and your actual spending patterns. This is not your grandfather's index fund. This is an active, data-driven management layer that most human advisors with 200 clients cannot replicate manually. So why does every financial advisor still have a job? Here is where the data gets more complicated and more important. On pure portfolio returns, robo-advisors typically deliver market-matching performance after fees. Betterment's compound annual growth rate since launch tracks a 60-40 benchmark, not a pure equity benchmark. It is not beating the market. It is matching what a balanced, diversified portfolio should do. Most platforms returned 12 to 15% in 2024, a strong equity year, and delivered positive returns in a more volatile 2025. Those are solid numbers. But here is what the comparison tables do not show you. Over a 20-year investment horizon, the fee gap between a robo-advisor and a traditional human advisor compounding over time is significant. Robo-advisors typically charge 0.25% annually. Traditional advisors typically charge 1%. On a $250,000 portfolio, that is $625 a year versus $2,500 a year. Over 20 years with growth, that difference compounds to tens of thousands of dollars. Money that stays in your account with a robo-advisor and goes to an advisor's firm with a human one. And Schwab's so-called free robo-advisor? The catch is an 8% cash allocation that creates what analysts call cash drag. On a $250,000 portfolio, that opportunity cost runs $800 to $1,200 a year in foregone returns during normal market conditions, making their zero-fee model effectively comparable in cost to the paid alternatives. But here is where the fear beat has real teeth. In February 2025, 23 million customers of Betterment received a surprise tax liability they were not expecting. Not because of poor investment returns, but because of how the platform handled a portfolio transition that triggered taxable events at scale. It was not a fraud. It was not a system failure. It was an AI-driven decision applied uniformly across millions of accounts that did not account for individual tax situations. Betterment agreed to a $9 million settlement with FINRA. That story did not make headlines in most personal finance coverage, but it tells you something critical. An AI system making decisions at scale, applied uniformly, will sometimes create an outcome that is statistically optimized across the whole population, but materially wrong for specific individuals. That is not a software bug. That is a structural limitation of how these systems work. There is also what the industry calls the fiduciary gap. Robo-advisors are legally required to act in your interest. They are fiduciaries by design. But approximately 70% of human financial advisors in the United States are not always fiduciaries. They are only required to recommend products that are suitable, not necessarily the best for you. That is actually an argument in favor of robo-advisors. The problem is what happens when you need someone to override the algorithm. During extreme volatility, when every rational model says hold, some individual situations genuinely call for a different action. A liquidity need, a tax event, a life change that the model does not know about. Robo-advisors with no human access have no mechanism for that conversation. You are either following the algorithm or you are on your own. And this is where the research draws a clear line. Morningstar's 2025 Robo-Advisor Report, the most authoritative annual study of these platforms, found that the category where robo-advisors most consistently underperform human advisors is not returns. It is behavior. Human advisors functioning as behavioral coaches, talking clients out of panic selling, building actual conviction in a long-term plan, providing accountability, add real, measurable value that cannot be automated. Vanguard's research has put the quantifiable value of a human advisor's behavioral coaching at approximately 1.5 to 3% of annual returns, not through better stock picks, but by preventing the panic selling that destroys long-term compounding. That is the number that rarely appears in robo-advisor marketing, because it is the number that most undermines the case for full automation. So here is the honest framework. The question is not whether AI can manage money. It demonstrably can. $1.8 trillion of evidence says it can. The question is what kind of money management you actually need. If your situation is, I want a diversified, low-cost portfolio, automatically rebalanced with tax loss harvesting, and I will not touch it when markets crash, a robo-advisor fully replaces a traditional advisor at a fraction of the cost, and your returns will likely be comparable or better after fees. If your situation involves multiple competing financial goals, estate coordination, insurance decisions, significant tax complexity, or the honest self-knowledge that you will panic sell when markets drop 40%, a human advisor's behavioral coaching alone is worth more than their fee difference over a 10-year period. The smartest approach the data actually supports in 2026 is not a binary choice. It is a combination. A robo-advisor managing the daily mechanics, asset allocation, rebalancing, tax loss harvesting, while a fee-only human financial planner, seen once or twice a year, handles the strategy, the tax planning, the estate coordination, and the conversations that keep you from making a catastrophic decision when your account balance drops by a third in 2 weeks. The practical translation: use Betterment or Wealthfront for your taxable investment account and let the AI run the portfolio. Find a certified fee-only financial planner, not a commission-based advisor, a fee-only planner, and pay them a flat rate for an annual financial plan. Expect to spend $2,000 to $6,000 a year on that advisor. And in between those meetings, use the AI planning tools in your robo-advisor to model your own scenarios. That is the hybrid model the evidence actually supports. Not full AI, not full human, the combination of what each does best. Here is where this sits in the bigger picture we have been building across this channel. AI is running parts of JP Morgan. AI is taking large portions of the analyst job. Agentic AI is completing entire finance workflows autonomously. And now, AI is managing $1.8 trillion of personal wealth. At every level of the financial system, from the institution to the individual, the same pattern is emerging. AI is absorbing the mechanics, and what is left, judgment, relationship, accountability, the decisions that carry a real consequence, is still human. The question at every level is the same. Do you know which role you're playing? Next on AI Capital Code, companies spent billions on AI and got almost nothing back. The real data on where AI investment is failing, why the average return is just 10% against a 20% target, and what separates the companies that are winning from the ones writing off the experiment. Subscribe so you do not miss it. And tell me in the comments, do you already use a robo-advisor? How has it performed?